What causes cash flow problems? There are 6 causes that cause 82% of the cash flow failures, and guess what? All of them are fixable. Your P&L is lying to you. Your bank accounts are what will tell you the truth. Here's how to tell the difference. By the end of this video, you're going to know the 6 causes that are draining your cash and how to solve those. I had a home builder that I was talking to one time, and they were doing millions in revenue every single year. And he told me one time, he said, hey, I got a $1.7 million of customer deposits sitting in my account. So naturally, I thought I was rich. And then my accountant came back and told me that a lot of that money has actually been spent on other things. And I realized I'm at sort of a crossroads of what to do, and it's a cash flow problem. There are too many business owners that we talk to that are in that same crunch. They're in that same peril, but they don't have to be. So let's answer what causes these cash flow problems using the acronym CAUSES, and then I'll talk to you about how you can solve that as well. One of the first major causes is chaos in your bank account. Now notice that I said in your bank account, singular. What we want to do, and a strategy we need to put, is make that plural. We need bank accounts. Too many business owners are running their business from 1, 2, or 3 bank accounts. In order for business to have cash clarity, so when a receivable comes in, we know what elements of those receivables are for us, for profit, for operating expense, for capital reinvestment, for whatever. We've got to start cutting those up, and so we need to subdivide the bank accounts. So instead of 1, 2, or 3 bank accounts, we need to have somewhere between 7 and 10 bank accounts is what we're looking for. So when money comes in, we've got radical clarity on what that money's since, what we can spend it on, so that we know how the cash comes in and the cash goes out. This is a psychological game. Don't try to do this on a spreadsheet. You want to do this with real, actual bank accounts, and it'll give you abundant clarity. I can't tell you how many clients have pushed back on us with this, and then within 3 months of starting to do this in subdivision bank accounts, they come back to us and tell us, I can't believe I waited so long to do this. It is clarity. I want clarity for you. And in order to get that clarity, we've got to see these causes, and part of these causes are chaos in your bank account. And while we're looking at the bank account and the actual dollars that are in here, we want to look at things that are real. As a business owner, you want to see reality and not hypothetical. And so what we're going to do is we're going to look at this idea of accrual accounting versus cash accounting. And as a business owner running a business, you're going to be far more educated about cash flow when you're looking at the actual cash rather than accrual. The best metaphor I can give you for accrual versus cash is to think about a party that you're throwing at your house. When you're doing an RSVP list and you have 50 people RSVP to the party, that's accrual accounting. And then you have 28 people show up at the party, that's cash accounting. The 28 people that show up are actual. That's actually happening. That's actually the amount of food you need, the drink you need, the space you need, all of that. But accrual are the 50 people that RSVP'd, and the delta between that, that's not actual. And as a business owner, you want to see actual. Listen, let your CPAs, your accountants, your bookkeepers deal with accrual stuff for whatever they need it for, but you focus on cash accounting. Anytime your CPA gives you a P&L, ask it for both an accrual and cash positions, so you can see what your actual cash position looks like, both from your cash accounts, now that you're going to have multiple, and also from your cash profit and loss statement. So that accrual mindset can create these cash flow problems. Also, an unfunded client deposits. Now, I didn't come up with that term. It's not a term you'll see out. That was one of our clients who said that. So unfunded client deposits, what does that mean? That means I'm taking customer deposits today for future projects tomorrow that I'm supposed to be putting in some sort of escrow account to keep aside because it's not technically my money yet, but I'm holding it just in case they pull out or for whatever reason for risk's sake. But typically what business owners will do is they'll take that cash deposit, instead of putting it in some sort of escrow, they'll actually spend it on something else. And now they're backing themselves up on cash flow. Another way to look at unfunded client deposits is spending tomorrow's money on yesterday's bills. Once you get into that cycle, that is something that is ultimately going to cause a cash flow crisis for you that you need to stay away from. Any customer deposits you take, just set up an extra bank account called customer deposits, and whenever you get a deposit, put it in that account. It'll act as an escrow so you're not tempted to spend it on other things. Well, Scott, what if I have to spend it on other things to keep it going? Well, now the business is talking to you, and so it's telling you there's got to be another way because you don't want to steal that customer's money. If you need to go generate a line of credit, if you need to go some other route, go that route so that we can see what the business is actually saying. But if you take that client deposit and pay it on yesterday's bills, the business is being falsed into thinking that it's actually operating profitably. and it's not. Another cause of these cash flow problems is spending without tracking. So how do we track? Well, we've put this in a model, and there's a couple things you can look at. So look at the right side of the page over here. First thing we want every business owner to do is rage over their money. What does that mean? We want you to be able to answer this question. How much revenue you're going to do this year? Nope, don't go look at the statements. Don't go look at your accounting software. Just tell us, ballpark, how much revenue you're going to do. If you can't answer that question, you got work to do. What's your associated cost of goods sold? Go ahead, say it out loud. And if you can't say it, you got some work to do. Now, based on your revenue and cost of goods sold, you should be able to find your gross margin. And from there, that educates you on what your expenses can be in order to maintain profitability. Because the gap between gross margin and expenses is your profit right here. And so if you rage over your money and know ballpark of what this is, then you've got good clarity about the macro picture. So now we need to look at the micro. This is how we run lean and fit into our slim pants. So in order to spend without tracking, we need to put in tracking metrics. So what are those tracking metrics? Follow the slim version. It's schedule, labor cost, inventory, and then any mistakes, warranties, or callbacks. That leads to the second version of pants and how we're looking at this from being able to fit into those slim pants. That's pricing, accounts receivables and payables, new equipment or capital reinvestment, taxes, that's like your quarterly estimated taxes, and then your servicing on debt. If you just had a spreadsheet and weekly reviewed these metrics of what that looks like, are we on schedule? What's our labor cost? What's our inventory management metric look like right now? What are our mistakes and our callbacks and all these things? Just put this on a spreadsheet, talk about it once per week, and you'll start to have clarity around what this looks like. But when we don't have this clarity, it begins to cause these cash flow problems because we don't have a tracking metric for that. Another cause is when our expenses begin to outpace our revenue. And there are a few ways that this can happen. One is that our revenue grows, we're excited about that growth, but frankly, we're not built to handle that growth, and so we panic, and we start to panic buy or panic hire or whatever. And so we grab up all these expenditures. A, we're not sure if the revenue is going to stay long-term or if it's just a one-time hit. We see that a lot with people. They'll land a huge contract, a big elephant. They'll scale up for the whole thing, and then they'll have to scale back down. A lot of corporations have been guilty of doing that, and they'll scale up for these big things and have to scale back down. But a lot of times our revenue, if we're not careful, will not be able to keep up with our expenses, usually because we're not tracking these things, and we're just making emotional decisions. And emotional decisions are a massive cause of cash flow problems. And that leads us to stick our head in the sand, which forces us to skip meetings. And so we need to have a weekly meeting around some of these tracking metrics. We need to have a weekly meeting looking at our cash account balance. We need to have a weekly meeting looking at our accounts receivables and payables. What do we owe and what is owed to us? And if we start to look at that every week, and we've got this tracking metric to look at here, then we've got radical clarity, which is going to stave off cash flow problems. But if we skip this meeting, then we stick our head in the sand, and now we're allowing those cash flow problems to rage again. Hey, I want to tell you this. You might be thinking, well, I'm not a CPA, I'm not an accountant, I don't have an MBA, I'm not a high finance person. I'm not either. In fact, all of the people we teach on this, half of them have not even gone to college. And so the reality is you don't have to be a college grad, you don't have to be a certified financial anything in order to have good practice, to subdivide your bank accounts, to look at cash level P&Ls, to not spend client deposits on things, to make sure that you spend time tracking in a metric. You don't need a high finance degree to know your revenue, your cost of goods sold. None of this do you need a finance degree for. All you need is RPMs. Those are the three letters behind your name. You know what they mean? Repetition, predictability, and meaning. Do it again. One of my coaches from college kept telling me, do it again, do it again, do it again. You know how many times he told me that? Or how many years he told me that? 4 years in a row. Do it again, do it again. And over time, I got better and better and better. And I stopped submitting myself to the causes that were going to create problems for me and instead leaning into the things that were going to cause flourishing in my position. I want you to flourish as an owner. And so we're here to help you with that. If you go to the description below, I've got a free tool for you called solvecashflow.com. It's a tool that my team and I have built. It's a handbook, cash flow handbook for you to sit down with and begin to methodically root out the causes of cash flow problems so that you can lean into flourishing, because I want you to be liberated from cash flow chaos so that you can make time for the things that matter most.